Welcome to the GCV Weekly Briefing Podcast, where we break down the key financial and economic developments shaping the landscape for investors, businesses, and policymakers. I'm Matthew, and this week we're unpacking four major stories. From questions surrounding Chancellor Rachel Reeves' spending plans, to a proposed move by the FCA that could open the door for more retail crypto investments, a shift in investor sentiment towards alternative assets, and a new contract secured by BAE Systems as global defence evolves. Let's get started. The first major story this week centres on Chancellor Rachel Reeves and her post-election spending pledges. She's committed to a sharp rise in public spending. Amongst other things, the NHS will receive an extra $29 billion a year, and schools are getting a $4.5 billion boost. Defence spending is also on the rise, climbing to 2.6% of GDP by 2027. Intelligence services will get additional funding too, pointing to a shift in focus towards both domestic and global security. But these pledges haven't landed smoothly with everyone. Critics are raising concerns about how it'll all be funded. One of the sharper responses came from Sir Mel Stride, who called it a spend now, tax later approach. His warning? That Rachel Reeves will eventually be forced to raise taxes to cover the shortfall. And that shortfall will be significant. According to Capital Economics, Reeves could be looking to fund a gap of between 13 and 23 billion when the autumn budget rolls around. That's well beyond 9.9 billion of headroom left after the spring statement. Further pressure is now coming from costly pledges like a 5.3 billion potential reversal of the two-child benefit cap and changes to the winter fuel payments. As Ruth Gregory, Deputy Chief Economist at Capital Economics, put it, whatever happens, it's clear even harder decisions for Reeves lie further down the line. The message is pretty clear. She'll either have to find new sources of revenue or make cuts elsewhere, likely under close watch from the markets. Next up, a regulatory shift that could change how British investors access crypto markets. The FCA is considering lifting its 4-year ban on retail investors buying crypto-linked exchange-traded products, also known as crypto ETPs. Right now, around 30 crypto ETPs are available on the London Stock Exchange, but they're off limits to everyday investors. Only professionals can access them. If this proposal goes ahead, retail investors would gain access too, but through safeguards and risk warnings. David Gale, director of the FCA, explained the reasoning, saying, "We want to rebalance our approach to risk. Lifting the ban would allow people to make the choice on whether such a high-risk investment is right for them." The UK is lagging behind Europe on this. Over 130 ETPs are already trading on exchanges in Switzerland, Germany, France, and the Netherlands. The Swiss exchange launched its first one back in 2018. Still, the FCA's move isn't without controversy. Some experts argue it could send the wrong message to inexperienced investors. Mike Barrett and Mike McCarthy are among those urging caution. McCarthy was especially blunt, calling some of these offerings spurious and toxic. So while the push is framed as part of making the UK more competitive, the FCA will have to carefully manage the trade-off between innovation and investor protection. Our third story looks at a growing trend among investors, moving from traditional public markets into alternative assets. With volatility still very high and the correlation between stocks and bonds tightening during downturns, many investors, particularly high net worth individuals and institutions, are looking elsewhere for returns. Private assets like venture capital, real estate, and private equity are gaining ground. They offer the potential for higher returns, albeit with more risk and lower liquidity. This isn't just about sheltering from short-term turbulence, but for many, it's about growth over the longer term. One recent analysis summed it up quite clearly. Private markets provide diversification and upside that public assets increasingly lack. Are more willing than before to accept illiquidity in exchange for higher growth potential, especially in sectors not accessible through the public exchanges. In today's climate, alternatives aren't just a hedge, they're becoming a core strategy for many portfolios. Our final story this week comes from the defence sector. BAE Systems, the FTSE 100 defence contractor, has landed an £880 million contract with the US Space Force. The task? Well, it's to build 10 satellites that will track intercontinental and hypersonic missiles from medium Earth orbit. These satellites will sit between 1,000 and 22,000 miles above Earth and use infrared technology to provide real-time missile tracking data to US defense teams. It's all part of what Donald Trump calls the Golden Dome, a planned $175 billion global defense missile system. It's modeled loosely on Israel's Iron Dome system, but designed to offer far broader global coverage. Trump described it as super technology that could intercept even nuclear missiles. He's called it essential to the survival of their country. But experts aren't all that convinced. There are real concerns about whether this is actually technically feasible, especially when it comes to countering next-generation threats from countries like China and Russia. And with a price tag at this scale, there'll be close scrutiny from both defense analysts and US lawmakers. This week's update paints a picture of change, and in some cases, tension, across government policy and investor strategy. On the domestic front, the Chancellor's fiscal approach could mean more taxes are on the way. In the meantime, investors seem to be rebalancing a little, looking for growth in private markets like venture capital and potentially soon new crypto assets if retail access is approved. Well, that's all for today's update. Thank you for listening to the GCV Weekly Briefing. I'm Matthew. See you next time.